The next part in the mortgage process is really understanding some of the language. So when a lender pre-approves you, right? You throw that phrase around pre-approval, it's basically mean you are applying with them for permission to buy money from them. And that buying money is given to different people on different terms. It's all about risk assessment, understanding how risky are you for them to give the money to, and what kind of risk are they taking on by giving you this money that it will be paid back in full and on time. Some of these systems I wouldn't say aren't necessarily fair because they're not explained until you have to go and apply for a mortgage. But the bottom of this slide is something that really want to drive home is that good lenders are really going to help you focus on your comfort and not just your max capacity. You can go online to LendingTree or a million other websites and just put your info in. They can spit out what's called a pre-qualification. That's basically just a rough, high-level look at your numbers based on the money that you say you make, the money that you say you have, the debts that you say you have, and your credit score. Pre-approval is a little bit more in-depth and important, especially when shopping in our area, because it takes a detailed look at what you have coming in, at all of your liabilities, at all of the documentation that lenders need to see later, so that when you do find that dream home and we have to propose terms to a seller, there's no doubt in their mind, in your mind, or in the lender's mind, how long it's going to take to help you actually close and buy that home. So a good lender helps you focus on comfort, not just max capacity. Just because you have that money in your pocket doesn't mean you want to spend it or have to spend it. And we want to make sure you understand what is the comfort number to be targeting. The vocabulary that your lenders are going to go through with you. A mortgage, like I said, that's the instrument that helps you buy the home by buying the money to buy the home. Pre-approval is what I discussed before of the lender confirming how much they're going to charge you to buy that money to buy the home. The term is how long you have to pay back the money that you're borrowing to buy the home. And mortgage insurance. This is a really important topic that a lot of people have questions about. And the best way I want you to think about mortgage insurance is it is another protection element for the bank against the risk that you don't pay them back because they're giving you more money. At the end of the day, mortgage insurance is something most buyers are going to have to contend with if they don't have that 20% down payment. As I said in one of the previous videos, we have plenty of buyers that purchase homes in our area with only 3, 5, or 10% down. You don't have to put down 20%. But if you're not putting down 20%, there will probably be mortgage insurance of some kind, and the lender will help you understand, is that an additional upfront cost, or is that something that will cost you a little bit more monthly? If it helps you get in the door though, it's just a price of doing business, and most of our clients only keep that first mortgage for 4 to 5 years anyway before refinancing into a different instrument or different product. So here are some of the phrases you're going to hear. We wanted to give them to you now so you're not hearing them for the first time when it's loan application time. You got a lot of different loan options that you can dive into as well. And we're not going to get into too much detail about it because this is something that is specific from person to person and specific depending on your pre-approval. But the main loans that most of our clients end up using are either conventional or FHA. Conventional is honestly the stronger in the eyes of the seller and more common in our market, especially in the city. But FHA is also a loan product that a lot of people use as well. It really just depends on how much cash you have to put down, what your credit score is, and what your debt to income ratio is. The lender, when you get pre-approved with them, they help you figure out exactly where all those things are. So you don't have to memorize it now. Just know that you'll probably have to decide between conventional or FHA. If you're a veteran, we thank you for your service, and you're available to get a different kind of product called a VA loan. We do tons of work with VA buyers in our region, especially because of the strong military presence. And there are a few special stipulations with that loan that make it a little bit different than the other two, but for those that qualify, it's an excellent loan product. And we've even had some clients that utilize that VA financing who were able to get more money back from closing than they were responsible for bringing to the table, and they were able to buy a house, take money away, and pay off other debts. Wow, right? Now, thanking them for their service is the least we can do, but just know that there are some special stipulations, and it's important that the agent you work with knows the difference between each loan type and can help you figure out which is the best for you. When you are getting pre-approved, there are really 3 main categories of things that a lender looks at, and we call these the 4 C's of mortgage pre-approval. One of our lenders, Matt Sines, a few years back gave us this slide, and we've just been continuing to grow on it and help people understand what they need to get ready for with pre-approval. So at this point, we want you to understand for that pre-approval that we're asking you to get, what is the bank actually going to be asking to pre-approve you? What documents are you going to need to have ready? The first three are things that you provide, and the last one, the appraisal, comes in when you're under contract. But as you look to get pre-approved, the three main things that a lender is going to look at for you is first, your character or your credit report. 640 is the minimum score for most of those conventional products, but with compensating factors, we've seen people get approved in the mid 500s. It really just depends on how much debt you have and how much cash you have. The bank is looking at you to determine how risky are you to give this money to. And these are the main factors that they use. So credit, character, cash or capital, again, how much money are you going to have available for your down payment, and then capacity, income, and employment. That's how much can you afford from a monthly perspective. As we look at those first three, those are all going to be verified by some really important documentation. So with the credit, it's your credit report, right? Remember we talked before about making sure that you're not just giving out your social security number to people because they're going to do those hard credit inquiries. You are going to need to get a hard credit inquiry from your lender, but here's a little secret. So long as you talk to different lenders within a 30-day time frame, the activity of getting your credit pulled for mortgage approval only counts as one hard pull. So I know a lot of folks get really anxious and say, well, I don't want to have all these people pulling my credit because it can have a bad impact. In every other scenario, that is the truth. But in this case, when you're shopping for a mortgage, it's okay to have a couple different lenders do it, just so long as it's within that 30-day time frame, okay? And they want to see something that's into the mid sixes ideally, but there can be compensating factors if that score is a little bit lower. The next thing that proves the cash and capital that you have is bank statements. You need to get really familiar with whoever you bank with, going onto that portal online or in the app and being able to export PDFs of your entire bank statement. The lender is going to want to see everything that went in and out in a month. This helps to establish trends and helps them understand just how much capital you actually have available to purchase your home. There are a couple different things to keep in mind there, like having funds, if they come as a gift from family, be seasoned in your account. Meaning that if you want to buy a house next week, you can't just have Uncle Joe put $5 or $6 grand in your account today, because the bank and lenders are going to need to see a paper trail and where that came from. So if you are someone that is fortunate enough to be getting a gift from family to buy your home, we want to know that in advance, and you want to make sure that the lender is aware so that it can be properly tracked from where it came from to your accounts, and that it's seasoned or in your accounts long enough to actually be used to purchase your home. There are a lot of really smart, really ingenious people that try a lot of different stuff with money. I just want to warn you now, you're probably not smarter than the underwriters at the bank. So there's no way we can really finesse or have surprise money come in. The earlier we know, the earlier the lender knows, the more we can make a plan for it. So just know that they're going to be asking where the money came from and let you see that paper trail. And the last thing that the lender is looking at to verify how much money you make or what your capacity, income, and employment are your pay stubs and your tax returns. Again, for self-employed people, for business owners, we are proud of you if you found ways to avoid the majority of your tax liability. But if you're looking to buy a home, the bank is really going to approve you based on that number that you pay taxes on. So for self-employed people, it's really good that we're starting this conversation early, because there may be a few additional things we need to put in place to make sure the bank fully qualifies all your income. But when you give them those 2 years of tax returns and your most recent pay stubs, that's what helps the bank confirm how much money you have coming in, so they can tell you how much you can afford from a monthly payment perspective. And then that last C for mortgage approval is the appraisal. And we're going to talk about that in a couple slides ahead when we talk about the home buying process. But these are the things that a lender looks at in terms of pre-approval. So get started early so that you can be on your best behavior, your best foot to get qualified for the right number for you.